All right, so Monday session in the New York session has just started, and I'm just going to pick up where I left it on Friday, which was um, the it was around about here. It's like 1 o'clock, midnight or something in Australian time. So it was around about here, and I remember saying, "Well, this trend is clearly broken. This is the key level, and I can see it heading there for a test," which it did, and it fell just short. I think it got to 44.78, and this is like 44.80, so all but there. And for the time being, it failed. So so I think, as I said, it was expected that it was going to touch there. Expected it was going to reject. It's overbought on the 4 hourly, overbought on the 2 hourly. You can see it's starting to turn now. Over the board on the hourly, heavily turned. Very overbought on the 15 minute, that it was, and had been showing negative divergence. So all the signs were there that it was going to get there and turn, which it did. And today and I guess the next couple of days are going to be quite crucial to see whether this holds, or whether it's going to head back and start making some new lows. I'm a bit skeptical about it resuming the bull market for the moment. And I guess, to state the obvious, if it's going to resume the bull market, it must break this. If it doesn't, the bear market is still in play. This trend line here is no longer relevant, that I see. It was never that neat to start with, but having said that, there was a big impulsive move through that level. But this is the big and definitive test, right? That trend line, or whatever, it's these price lines that are far more unambiguous than trend lines. This trend line's a bit different because it was so long and well established. This one is a little bit sloppy because where you want to draw it, it's kind of could be there, right? You could wipe out some noise, which I normally do, to take it to there. You could have said there's one, there that had, tested a few times, false break, definitive break, retest, whatever. So you could draw that a few lines, a few ways. The definitive level is definitely this one, though, because that's where the pattern of the, lower low compared to there, and a lower high compared to there, and a lower low compared to there, and a lower high so far, just by a little bee's proverbial, but it certainly hasn't made a higher high, and until it does that, the bear market is still in play. I do think, though, that there is a very good chance of just some sideways choppy action for a while. Breaking through here is going to be tough. So we've seen that there. Breaking through there certainly looks easier than there, right? But there's a few things that are still in the back of my mind that mean that I'm still with a bear buyish. I've still got my shorts in here. I think this is a great level to be short at. Stops up here. Risk reward is very strong for a down move. I guess some of the reservations I've got is that this level here was never fully tested, and that level there, it's not just a previous high that had a bit of work done and then retested, but it's also like the first base for any retracement. And this is a retracement, right? This is clearly a long-term trend that has been broken, and you would expect it at the very least, to come back to that level at the very least, and it hasn't done that yet. And I think until it does that, I think that it's well, put it this way, I just think there's a very good chance that it will go there and when I look at it on a technical basis, it ought to, right? It ought to do the right thing. Right. Now, if I go back to just look at it, also the other thing that I've got in mind is that the trading action on the 17th and 18th, on the 17th and 18th, the 17th and 18th, the 17th and 18th, the 17th and 18th, we're at those trading sessions now when you adjust it for weekends. So the next 2 days are going to be critical to see whether the price action of 1, 2, 3, 4, and 5 previous months happens again. If it does, I'm going to claim the Michael Burry Award for the great short run. It'll be interesting to see if it does, because it said, when I first started posting these videos, it really was on the back of after this move saying this is going to happen again. And when it does, it'll cause some damage, and of course it did, and it caused some damage, and we've been recovering ever since. And if the same seller comes in, that's been doing it for these last 5 months, comes in and does it again, they'll come in today and tomorrow, I expect, and they'll force the market down another anywhere between 1.5% and 3.5%, I would say. Now, when I just look at it on a long-term basis, these are some other things that affirm my bias for the case for a correction. When I go back to look at it from the GFC, right? I'll take and say that point there, that low, I guess those lows, wipe out a bit of that noise, these lows in here, that corrective, a little correction there. When I look at that, right, that's a very solid trend line. I want to look at the upper bound of it. Right, we're right at the top of it, and so in the scheme of things, the little correction we've had here is absolutely trivial and not worth a mention whatsoever. Frankly, right, when you look at it on the longer term, it could be the start of something bigger. Now, if it is, what are we looking at? Right, we're looking at a move here. That was to the 61 retracement when we go from the bottom of the channel to the top and then the correction, right? When we look at from here, the bottom of this channel to the top where it corrected is 23, and that is the first base, right? When we look at it here from this channel here, the 23, the first base, is that 4,000 mark, and that just takes it to the middle, right, of that channel. So to me, that 4,000 level is really looking almost like a bare minimum for where it ought to retrace to sooner or later. Okay, now it might take a little while to get there, and as we wind down the clock, it might not be until another 6 months, for example, right? We could be in for a reasonable correction, and this could still grind higher. That's what happened here. So this ground higher from 2013 to 2015, good 18 months. Okay, here was just a touch. Here we had a few goes at it, like from January 2011 to July 2011, so that was over 6 months. I've got a feeling this one will be short just because it's had this big sharp run up and it looks a little bit more like this, right, than that. Okay, now I guess we can see some other similarities just in the lead up on a smaller scale where we had like this high low kind of pattern, which is like that, high low, then the big high there. This on a macro scale, on a big scale, looks very indecisive, where it's had like a higher highs but also lower lows on this big time frame. To me, that's structurally weak, right? It says indecision, right? this says euphoria, and when I look at this long term going back, 12, 13 years, a pullback to here makes a lot of sense. So that's where I'm seeing the US market on a longer term basis as well as just today. And just to get into in the middle of it, when I look at it on the 4 hourly, which is what I prefer, there is just a few things that stand out to me very clearly when I look at this market that I think just sums it up in a nutshell, right? Which is 1, trend broken. 2, level not reached. 3, critical point. And that's basically the market today. So that's really the takeaways. I suspect that it's still forming this correction. This is the first stop for it to go to, which would be that 23 level, 23 retracement, with a good chance of it going into this, 4,000, 4,050 range, which is the retracement of the whole move on a longer time scale. So that's really what I've got in mind for the markets this week. As you can see, that's the 23 retracement for the whole move. That's broken. This hasn't been tested. This is held. If this holds, it's going down here. That's it for today. Actually, there is one other thing I'm going to look at, right? Which is the US yields. Because when we look back here, this is like 2018. This is the move in 2018. 20%, right? And that was from September. It started in September, went through to December, so 3 months. When we look at the US yields, now the US yields have been on the move. Now we all know that, but they look like they were tailing off, but they have come back. All right. Now this is 2018, right? That's where yields were, okay? And those yields, to trigger that 20% moved like 190 points, right? Now that 190 point move, right, from the low here, similar one, would take us up to around about 240, right? So that's one level in terms of an equivalent move. We're going to look at some extensions here, okay? Let's see where they take us, right? Look at that. Right. Now, we see this move here, this good zigzag here, right? Okay, right? I can see that same thing happening here, right? And if it happened to the same degree here, right, like here as it did there, right, then we're looking at this level here, 240. And it could be, if we do the 1.6, extension, then it would take us up to this level here, right? Let's make that one a bit fatter, right, so we can see it nice and clearly. It would take us there, right? And now when we look at this bond market on a longer term basis, right? I'm just going to clear out some of this noise here. Okay, we can see that over the longer term, this market has been coming down for years, decades, right? This goes back to, this is like 1987, and it certainly had a false break here, and it's looking like we are shaping up for another one. We've had these two little tests, a little test in there, and could be shaping up to have another one. And when we look at the way in which these markets work, you can see they hit lows, right? And they kind of recalibrate, right? So they hit a low, they come back, muck around with a bit, and that then becomes the new high for it, because basically the central bank's lower rates, right, stimulates the economy, everyone gears up, and you can't raise rates back to the same level because everyone's got more debt, right? So in a way, it's a bit of a stupid tool, right? But this time we've kind of had rates essentially, this is a 10-year rate, right? We've had rates essentially at zero. And so it is a bit of a D-Day. Are these things going to finally break this ratcheting cycle? If they do, where's the first point for this to go to? It's there, okay, which is 3.18, 3.2%. I guess you could argue that there is something in here, right? Around, say, 240, okay? Now, the funny thing about that 240 mark, as you might remember, right, from there to there, that's that 185, 190 mark. That's where it would take us to. That similar move from 2016 up to 2018, which then triggered like a 20% collapse in the market, or correction in the market. It was part of it. That would take us to the midpoint of this previous range that we were in. So I think that these treasury yields have got a fair bit more to run. First stop there, 235. Potential scenario up to there. That would be a massive move, and this move, it has started, right? In a way, like we're halfway there, right? We've already gone from 46. We've already made like 100 points out of the 190 points, which was from there to there. And just as this had that breather, this has had a breather. We could well be heading there. That looks very likely to me. And if that happens, then there is no reason why we wouldn't be seeing a correction in the market of 20%, which is what we saw here. 20% there. Where's that going to take us to? It looks pretty painful, doesn't it? All right, 3,600. That would be the 20% correction. But then again, when we zoom out and look at it on the scale since the GFC, that 20% doesn't actually look so nasty at all, because it would just take us to the bottom of that range, right? So a lot of these things kind of line up. Yields on the move, we're halfway there to a similar move that triggered a 20% correction back in 2018. 20% here would take us down to the bottom of the channel. So to me, when it comes down to that risk reward of what have I got on and why, we've got a monthly bearish engulfing candle, which is certainly a purveyor of bad things to come. We've got a key level, right, that is so far held and that we're turning away from, and we could certainly see some damage continuing. That's probably enough of a ramble from me. That's it. Have a good one. Ciao.